the largest holding in the stable fund is domestic equities, excluding cash. So 23.8% of the fund is currently in domestic equities. Even though there's been a re-rating of domestic stocks since the ANC elective conference, we continue to find attractive opportunities in the local market, and we believe there's still a tremendous margin of safety in many of the companies we hold. The P/E ratio of domestic stocks held in the PSG Stable Fund is currently 13.2. Although we don't think a P/E ratio is necessarily always the best measure of value, it just gives an indication that the stocks certainly aren't overvalued. On the offshore equity side, we continue to find opportunities. It's 12.8% of the fund at the moment. Although the markets have run globally, these equities we believe are still undervalued, and they are well diversified across industries and across geographies. So on a risk-return basis, we think this is a very good portfolio, which we are excited about. The long end of the government bond in South Africa, we think, is offering of the most attractive real yields on a global basis. Currently, on 20-year bonds, you can get a yield of 9.5%. If inflation is going to be at the upper end of the range of 3 to 6%, that's a real yield of 3.5%, which we think is very attractive. At the moment, inflation is significantly below the upper end of the range, which means you're getting a real return in excess of 5%. And at the moment, we've got quite a large exposure, and that's 15% of the fund. Domestic cash, which is a function of how many opportunities we're finding in other asset classes, we don't target a specific cash level, is currently 26%, of which 17% is in NCDs longer than 1 year, and the remaining 9% is effectively in immediate cash of shorter than 12 months. The NCD exposure is a function of finding attractive real yields across the NCD curve over the last number of years and locking in real yields, yields significantly ahead of inflation.